For years, Americans were told one thing: housing prices only go up, buy now or get left behind. That was the mindset during the pandemic housing boom. People rushed into Florida, Texas, and Arizona believing those markets would stay hot forever: cheap mortgage rates, remote work, investor money. Migration from expensive blue states, everything pushed prices higher, and for a while it worked. But now, the market is changing fast, and some of the hottest real estate markets in America are suddenly showing serious signs of weakness. Inventory is rising, homes are sitting longer, price cuts are spreading everywhere, and buyers finally have leverage again. But here is the important part: this is not happening equally across America. Some states still look stable. Some luxury markets are barely slowing down, but places like Florida, Texas, and Arizona are becoming the biggest warning signs in the entire housing market, and the numbers are becoming impossible to ignore. Florida is becoming one of America's weakest housing markets. Florida was one of the biggest winners of the pandemic boom. Millions of Americans moved there chasing lower taxes, warmer weather, cheaper living, remote work lifestyles. Cities like Tampa, Orlando, Miami suburbs, Cape Coral, Fort Myers experienced explosive home price growth between 2020 and 2022. But now the market is cooling rapidly, according to recent housing market data. Florida has become one of the softest major real estate markets in the country. In some parts of Florida, around 30% of listings have already taken price cuts. In Tampa, St. Petersburg, Clearwater, nearly 21% of listings experienced multiple price reductions. That is a massive shift from the pandemic frenzy. Back then, sellers could almost name any price and still get offers. Now homes are sitting on the market for months, especially homes above $500,000, and that changes buyer psychology completely. Because once buyers realize homes are not selling quickly anymore, they stop panicking. They wait. They negotiate, they compare listings, and sellers lose leverage. Florida's statewide median home price is still around $415,000 to $420,000. But the bigger issue is not only price. The real problem is ownership cost, because in Florida, buying a house is no longer just about the mortgage payment. Insurance costs have exploded, property taxes remain high, HOA fees continue rising, maintenance costs are brutal in hot coastal climates, and utility bills are becoming more expensive. This is where many buyers get trapped. A home may look cheaper after a $20,000 or $30,000 price cut, but the monthly ownership cost can still feel impossible. That is why Florida is becoming dangerous. The affordability crisis is no longer just about home prices. It is about the entire financial burden attached to ownership. And buyers are starting to realize that. Some analysts now believe Florida could continue weakening even if mortgage rates slowly decline, because lower prices alone may not solve the monthly payment problem. Texas is no longer the untouchable housing market. Texas may be the biggest psychological shock in America's housing market right now, because people truly believed Texas could never slow down. Austin became one of the hottest real estate markets in the entire country during the pandemic. Homes received bidding wars, cash offers, waived inspections, aggressive investor demand. Builders started constructing new neighborhoods everywhere. People thought prices would keep rising forever. Now the market looks completely different, according to recent 2026 housing reports. Home prices across many Texas cities are now declining year over year. Statewide Texas median home prices have fallen around 1.7% to roughly $342,000. Austin prices have dropped roughly 2%. San Antonio prices have fallen around 3.3%, and inventory has exploded in some areas. San Antonio now has roughly 6.5 months of housing supply available. That is a completely different environment from 2021. Back then, buyers had almost no negotiating power. Today, buyers can negotiate below asking price, request repairs, ask sellers for closing cost assistance, compare multiple homes before making decisions. Some buyers in Texas are reportedly negotiating prices nearly 10% below asking price in certain situations. That would have been almost impossible during the pandemic boom. Austin is showing even more signs of weakness. The metro area recently reached nearly 10,000 active listings. Homes are averaging around 91 days on market. And more than 30% of listings are taking price cuts. That is not normal in a euphoric housing market. That is what happens when sellers start competing against each other for a smaller pool of buyers. But here is the important opposite perspective. Texas is probably not collapsing the way social media doomers claim. Prices are still far above pre-pandemic levels in many desirable areas. And Texas continues attracting population growth and business investment long-term, so what we are seeing may not be a total housing crash. It may simply be a massive reset after an unsustainable boom, but affordability remains a huge problem. Mortgage rates are still hovering around the mid-6% range nationally, and that changes everything. Because even after prices cool, monthly payments still feel painful. One report showed renting in Austin is now approximately 117% cheaper than owning. That statistic alone explains why buyers are becoming cautious. A softer market does not automatically become an affordable market. And that is the key mistake many people are making right now. Arizona is quietly turning into a buyer's market. Arizona experienced one of the fastest housing booms in America during the pandemic. Phoenix became a relocation hotspot. Remote workers flooded in, investors flooded in, speculators flooded in. Prices surged rapidly, but now Arizona is clearly slowing down too, according to Zillow data. The average Phoenix home value dropped to around $403,827, down approximately 3.7% year-over-year. Realtor.com data shows median listing prices around $485,000, median sold prices closer to $465,000. Active listings up more than 65% compared to 3 years ago. Median days on market increased to 53 days. And rents are weakening too. Phoenix median rent recently dropped nearly 6.9% year-over-year to around $1,549 per month. That matters because investor demand depends heavily on rental income. If rents weaken while financing costs remain high, investors become much more cautious. And once investors slow down, one of the biggest engines of the housing boom disappears. Phoenix is also showing another major warning sign. More than 63% of home sales are now happening below list price. That means most sellers are no longer getting what they originally wanted. Buyers are negotiating harder. Sellers are lowering expectations, and the psychology of the market is shifting, but again, this does not necessarily mean Arizona is collapsing. Some analysts believe Phoenix is simply returning to a more balanced market after years of irrational growth. Well-priced homes in desirable neighborhoods are still selling. Overpriced homes are the ones getting punished hardest. And that distinction matters, because the next phase of America's housing market may not be a nationwide crash. It may become a neighborhood-by-neighborhood correction. The housing market is splitting into two Americas. This is the part many people still do not understand. The U.S. housing market is no longer moving together. America is slowly splitting into two different housing economies. One side still has wealthy buyers, low inventory, strong job markets, expensive coastal demand. These areas remain surprisingly stable. But the other side, especially pandemic boom markets, is weakening much faster. Florida, Texas, Arizona. These markets experienced some of the most aggressive price growth in modern housing history. Now they are dealing with the consequences. Higher mortgage rates, higher insurance costs, more inventory, weaker investor demand, and buyers who are simply exhausted financially. So have these markets finally hit bottom? This is the biggest question in America right now, and the honest answer is nobody truly knows, but there are signs that some Sun Belt markets may be approaching a reset zone. Especially areas with oversupply, heavy investor activity, rapid pandemic appreciation, aggressive new construction. Rising insurance burdens. The problem is that affordability is still broken nationally, even after some price declines. Mortgage rates remain high, taxes remain high, insurance remains high, maintenance remains expensive. So a cheaper home does not automatically become affordable. That is why many buyers are still hesitant. And this is where timing becomes dangerous, because housing markets move slowly. Psychologically weak markets can remain weak for years. A market does not instantly recover just because prices fall 5% or 10%. The smart strategy in 2026. Right now, smart buyers are not blindly chasing hype anymore. They are watching the numbers carefully. The most important things to monitor are inventory growth, price cuts, days on market, insurance trends. Rental demand, local job markets. In Florida, insurance may become the biggest long-term risk. In Texas, overbuilding and builder incentives matter most. In Arizona, investor demand and rent weakness are critical signals. And here is the most important thing buyers should understand. A falling home price alone does not create a good deal. The real question is whether the total monthly ownership cost finally makes sense. Because America's housing problem was never just about home prices. It was about the entire financial system attached to homeownership. Mortgage payments, insurance, taxes, HOA fees, maintenance, utilities, repairs, commutes, all of it. And now the market is slowly forcing buyers, sellers, and investors to face reality again. The easy money era is over. Now the numbers actually matter.